Hello friends, in this video, I would like to explain what you as an investor should look at before buying banking stocks for your portfolio. We have curated a list of 7 best banking stocks to buy, which are HDFC Bank, Kotak Mahindra Bank, ICICI Bank, Axis Bank, Bandhan Bank, IndusInd Bank and City Union Bank. This list of stock is for a longer term horizon, keeping several fundamental factors in mind. As an investor, this video will guide you to make your own checklist and research these stocks better. Firstly, a brief on banking sector. Now, financial services constitute close to 35% weight in Nifty 50 index, with banking players forming the majority chunk. Banking sector is the backbone of economy and also goes through its own phases of ups and downs. When everything in the economy is rosy, lending and borrowings boom, and this in turn leads to a healthy growth in banks. And when going gets tough, default rises, which in turn lead to an increase in bad assets, that is nothing but bad loans. Now last year, Prime Minister Narendra Modi set a USD 5 trillion economy target for India Inc., which is to be achieved within the next 5 years. However, taking into account various challenges due to lockdown and economic slowdown, credit from banks must grow at close to 12% every year in order to at least aim for a USD 5 trillion economy figure by 2024. And these banking players have always remained resilient, have grown consistently through multiple economic cycles in order to capitalize on every opportunity. While considering an investment in financials, especially in the banking space, utmost importance is placed on management's understanding of resilient growth risk matrix. A bank should ideally be cherry-picked on the sheer balance between garnering market share and not distorting the risk matrix in place in order to chase market share. Now let's look at specific factors which you must consider before picking banks for your portfolio. Net interest income. Now NII is nothing but a difference between interest earned from lending activities and interest paid to various account holders on their deposits. Now CAGR of NII is to be calculated to analyze the performance and trend. Looking at example of HDFC Bank, over the past 5 years, the bank has managed to grow its NII at CAGR of close to 16%, while its net profit also grew at CAGR close to 16% in 5 years. Now these are superior numbers for both NII and PAT in the banking space. HDFC Bank along with Kotak Mahindra Bank are leaders of banking space and can be a good starting point as a benchmark for your stock analysis. Now coming on to advances, banks' primary earnings come from their assets. Now this is nothing but loans given to customers and hence it is considered as asset in business and is one of the most important metrics in stock analysis. Increase in advances and the rate of increase will inform us how the bank is growing their business. Now we can see that advances for HDFC Bank has grown at a CAGR of close to 16% over the last 5 years. When we come to deposits, banks accept deposits in form of term deposits and savings and current account deposits. Banks lend out most of the deposits it receives. Accordingly, deposits forms major source of funds for the bank. Analyzing deposit numbers would imply how comfortable bank is able to acquire funds which they lend. HDFC's deposit grew at a CAGR of 16.45% over the last 5 years. Next is net interest margin, that is NIMs. This can also be calculated by dividing net interest income to interest-bearing assets. The higher the NIM, the better it is. But it is of utmost importance to check the trend of NIMs on a YOY basis as well as on quarter-on-quarter basis. NIMs should be consistent throughout the last few years. For instance, Kotak Mahindra Bank since last 5 years has been able to maintain their NIMs between 4.3% to 4.60%. Moving on to the next parameter, cost to income ratio. This ratio helps in assessing the profitability of banks. If we see the ratio rising over years, it means that the costs are rising at a higher rate than income. However, lower ratios suggest a higher profitability. We see that Kotak Mahindra Bank's cost to income ratio is on a declining trend and now currently stands at 47% on March 31, 2020, which suggests that income is rising at a higher rate than costs. Now we look at net non-performing asset, that is also known as NPA. A loan asset becomes non-performing when it ceases to generate interest income for the bank. Net NPA ratio is the ratio of net non-performing assets to net advances. it is important to check the trends of NPA, which would determine asset quality of banks. Generally, there is a stark difference between the asset quality of private and public sector banks. Now, public sector banks usually have a higher NPA of 2% and above, while NPAs of private sector banks are in the range of 0 to 2%. We see that HDFC Bank's NPA is slightly rising but is now pegged at 0.36%, which is the best asset quality in the entire Indian banking industry. Now the next thing you should look at is current account and savings account ratio, which is also known as CASA ratio. Now this is a ratio of deposits in current and savings account to total deposit. A higher CASA ratio means a higher portion of deposits of the bank has come from current account and savings account deposit, which is generally a cheaper source of funding as banks provide low interest rates in savings account and no interest rates on current account. High CASA ratio indicates low cost of funds and which in turn helps in better NIMs. Kotak Mahindra Bank's CASA ratio stands at 56.20%, which is the best in the entire industry and means that nearly 56% of the total deposits are from current and savings account. Now, maintaining provision for any asset deterioration is a prudent approach for a bank, and hence provision coverage ratio is another important ratio. Now, PCR indicates the extent to which the bank has provided for the weaker part of their loans portfolio. When the PCR is high, it suggests that the bank has made additional provisions for bad loan in coming years, thus reducing the unexposed part of bad debts. HDFC Bank's PCR stands at 71.36%. Capital adequacy ratio is also known as capital to risk weighted asset ratio, CRAR. Now, capital adequacy ratio is the ratio of bank's capital to aggregate risk weighted assets. This ratio is decided by central bank, that is the Reserve Bank of India, in order to prevent commercial banks from taking excess leverage. We see that among the model portfolio, Bandhan Bank has the highest CRAR at 19.80%, whereas IndusInd Bank's CRAR is at 15.04%, but which is still above all public sector banks' CRAR. Now, these were some company-specific factors, but there are other macro challenges a bank faces. Currently, COVID-19 has raised doubts on banking sector's ability to grow strongly with sound asset quality in near term. Prudent banks are preparing for an unforeseen rise in NPA, which has kept provisions elevated, impacting the profitability, and in an effort to be proactive, many have already raised buffer capitals. Moratorium by RBI has certainly kept asset quality stable, though revival in payments when the moratorium ends remain an overhang. Moratorium is expected to create a new cycle of bad loans in the entire banking industry. The sectors as a whole is likely to witness new NPL, especially from industries like airlines, hotels, entertainment, leveraged corporates in real estate, power companies, NBFCs, as well as unsecured retails to an extent. And hence, the process of recovery could certainly be delayed. However, in order to provide further support to the borrowers, RBI is mulling on a one-time loan restructuring scheme. But how that works and how many borrowers repay their loans, only time will tell. The possibility of defaults will certainly keep this sector under pressure as a whole, but the moat and ALM experience that each of them carry will certainly enable growth over a longer period of time. So you should keep checking all these parameters before adding a bank to your portfolio. That's all for now. Thank you.